The stock market closed lower on Monday, December 30th, 2024. It was, well, a quiet day for trading. Many investors were already gone for the holidays. The Dow Jones Industrial Average dropped by 272 points. That's a 0.6% decrease. The S&P 500 and Nasdaq Composite also fell. They were both down by 0.7%. This dip might signal a weekend to an otherwise strong year for the stock market. Many analysts are watching closely. They want to see if this downward trend will continue into the new year. Despite Monday's losses, the major stock market indices are up significantly for the year. The S&P 500 has had its best year since 2021. It's up by 23%. The Dow Jones Industrial Average is also up, showing a 13% increase. The Nasdaq Composite has seen the biggest gains. It's up 30% for the year. This puts it on track for its longest winning streak since 2021. These positive numbers show the resilience of the market. Despite global uncertainty, investors have remained largely optimistic. This positive sentiment has driven stock prices higher throughout the year. There was no major news that caused Monday's decline. This suggests that other factors were at play. Two likely culprits are profit-taking and rising bond yields. Some investors may have been selling stocks to lock in profits before the year's end. Additionally, when bond yields rise, they can make stocks seem less attractive to some investors. This can also lead to selling. Experts are divided on what to expect from the stock market in 2025. Jeremy Siegel of Wharton predicts a pause in market growth. He believes a 10% correction is possible. In contrast, Tom Lee of Fundstrat thinks the market could rebound in early January. These differing opinions highlight the uncertainty surrounding the market's future. It's a reminder that predicting the market is notoriously difficult. Investors should be prepared for potential volatility in the coming year. Many investors are hoping for a Santa Claus rally. This is a phenomenon where the stock market tends to rise in the last 5 trading days of December and the first 2 of January. History shows that the S&P 500 has averaged a 1.3% return during this period since 1950. While a Santa Claus rally is not guaranteed, it has occurred frequently in the past. If this trend continues, it could provide a boost to the market after recent losses. Beyond the broader market trends, several specific news items are impacting individual stocks and sectors. These developments can often be the difference between a stock's rise or fall, and they provide a deeper insight into the market's intricate dynamics. Nvidia was the only Dow stock to gain on Monday, rising by 1.7%. This increase was driven by strong demand for their graphics processing units, which are essential for gaming, data centers, and artificial intelligence applications. Investors are optimistic about Nvidia's future growth, especially with the increasing adoption of AI technologies. ConocoPhillips is expected to rebound in 2025 after a 16% decline in 2024. Analysts attribute this anticipated recovery to rising oil prices and the company's strategic investments in renewable energy projects. The energy sector remains volatile, but ConocoPhillips' diversified portfolio could position it well for future gains. MicroStrategy shares fell over 7% after the company announced more stock sales to buy Bitcoin. This move has raised concerns among investors about the company's heavy reliance on cryptocurrency, which is known for its high volatility. While some see this as a bold strategy to capitalize on potential Bitcoin gains, others worry about the risks involved. Natural gas futures jumped 19% to a 52-week high on forecasts for colder than usual January weather. This surge reflects the market's sensitivity to weather patterns, as colder temperatures increase the demand for heating. Energy traders are closely monitoring weather forecasts to anticipate further price movements. Pending home sales rose 2.2% in November, exceeding expectations. This uptick suggests a resilient housing market despite rising interest rates. Factors such as low inventory and strong demand continue to drive home prices up, making real estate a key area of interest for investors. The Chicago PMI, or Purchasing Managers Index, fell to 36.9 in December, below expectations. This decline indicates a contraction in manufacturing activity, which could signal broader economic challenges. Businesses are facing supply chain disruptions and rising costs, which are impacting their production capabilities. These diverse market movements highlight the importance of staying informed. Investors need to keep an eye on various factors, from company-specific news to broader economic indicators, to make well-informed decisions. Staying updated can help in identifying potential opportunities and avoiding pitfalls. Events in different sectors and with specific companies can create opportunities or risks for investors. By understanding the underlying causes of these movements, investors can better navigate the complexities of the market and make strategic choices that align with their financial goals. Section 7. Signals from technical indicators. Technical indicators suggest potential weakness in the market. Over 80% of S&P 500 stocks are trading below their 50-day moving average. Many are also below their 200-day moving average. These indicators are used by traders to identify trends in the market. When a large percentage of stocks are trading below these moving averages, it can be a bearish signal, suggesting further declines may be ahead. Section 8. Ripples in the global market. The US tech sell-off has impacted global markets. The FTSE 100 in London dropped in response to the decline in US tech stocks. Additionally, South Korea's decision to inspect Boeing B-737-800 planes following a Jeju air crash is impacting Boeing's stock price and the broader aviation sector. These events highlight how interconnected global markets are. News and events in one part of the world can quickly impact markets and investors around the globe. Section 9. Strategies for minimizing losses. In this section, we will explore various techniques and methods that can help you safeguard your investments and minimize potential losses in the ever-volatile financial markets. It is impossible to predict the market with certainty. The financial markets are influenced by a myriad of factors, including economic indicators, geopolitical events, and investor sentiment, all of which can change rapidly and unpredictably. That's why it's crucial to have strategies in place to minimize potential losses. By being proactive and prepared, you can better navigate the ups and downs of the market and protect your investments from significant downturns. Set stop-loss orders. This involves setting a specific price at which you will automatically sell a stock if it falls below that level. Stop-loss orders act as a safety net, ensuring that you don't hold on to a losing position for too long. This helps limit your downside risk. By having a predetermined exit point, you can avoid the emotional decision-making that often leads to larger losses. Stick to your plan. Don't let emotions dictate your trading decisions. Emotional trading can lead to impulsive actions that are often detrimental to your financial health. Have a written investment plan and stick to it. Your plan should outline your investment goals, risk tolerance, and strategies for different market conditions. This will help you avoid making impulsive decisions based on fear or greed. By adhering to a well-thought-out plan, you can maintain a level-headed approach even during market turbulence. Diversify your portfolio. Don't put all your eggs in one basket. Diversification involves spreading your investments across various asset classes, sectors, and geographic regions. Diversifying across different asset classes, sectors, and geographic regions can help reduce your overall risk. By not being overly concentrated in one area, you can mitigate the impact of a downturn in any single investment. Consider dividends. Investing in dividend-paying stocks can provide a stream of income, even if the stock price declines. Dividends can act as a cushion during market downturns, providing you with regular income regardless of market conditions. Remember, investing involves risk. By implementing these strategies, you can manage that risk more effectively and protect your capital. Consistently applying these principles will help you build a resilient investment portfolio capable of weathering market volatility. Section 10. Tax implications of selling. Selling stocks at a loss can have significant tax implications. When you sell an investment for less than what you paid for it, you incur a capital loss. This loss can be used to offset capital gains, which are the profits you make from selling other investments at a higher price than you paid for them. It's important to understand these implications to make informed investment decisions. By strategically selling losing investments, you can reduce your taxable income and potentially lower your tax bill. This process is known as tax loss harvesting. Offsetting gains. Selling losing stocks can offset capital gains you've realized from selling other investments at a profit. For example, If you have a capital gain of $5,000 from selling a stock, and a capital loss of $3,000 from selling another, you can offset the gain with the loss, resulting in a net capital gain of $2,000. This can reduce your overall tax liability for the year. Additionally, if your capital losses exceed your capital gains, you can use the excess loss to offset up to $3,000 of other income, such as wages or salary. Tax loss harvesting. This strategy involves selling losing investments to offset capital gains and potentially reduce your tax bill. It's a valuable tool for managing your investment portfolio and minimizing taxes. It's essential to consult with a tax professional to understand the specific tax implications of selling stocks at a loss in your jurisdiction. Tax laws can be complex and vary widely, so professional advice is crucial. They can help you develop a tax-efficient investment strategy, ensuring you make the most of your investments while minimizing your tax burden. By understanding and utilizing these strategies, you can make more informed decisions and optimize your financial outcomes.